India-US trade deal is finalized, everyone says it's positive for India, but markets don't reward everyone equally. So, which sectors actually benefit from this deal and which ones might struggle? That's the right question because trade deals don't create universal winners. They redistribute the advantage. Understand till the end because this is where real investment clarity will come from. Markets don't trade deal, they trade impact. The trade deal changes competition, cost structure, access to markets, efficiency threshold, and sectors react differently based on how prepared they are. First, export oriented sectors, textiles, manufacturing, select chemicals, industrial goods. Why? Because reduced friction and better market access improves long term demand visibility. These sectors don't explode overnight, but they compound quietly. Trade deals reward consistency, not excitement. Now, many expect the IT to rally strongly, but reality seems to be different. IT benefits from global stability and stronger US demand over time, but near term spending remains cautious. So IT isn't a loser, it's a slow responder. Now, coming to capital goods and manufacturing sector, this is where the deal quietly helps. Capital goods and manufacturing benefit from better technology access, stable supply chains, long term investment clarity. Now, these sectors move early when investors think long. So, now coming to the pressure zone, protected and low efficiency sector. So, now what's the uncomfortable part? Sectors that relied on protection or lagged efficiency face pressure. When competition increases, pricing power reduces. Now, this doesn't mean collapse, it just means adjustment. Now, what happens to the banks and large financials? Banks are not the direct beneficiary, but they are the indirect winners. Why? Because trade boosts investment, investment boosts credit, and credit boosts the financial activity. That's why large financials often stabilize first. So, what about the small caps and the mid cap? Smaller companies need proof. They benefit later when execution becomes visible. That's why markets start with large caps, liquid names, proven balance. Breadth expands last. So, how should investors use this information? This is not about chasing stocks, it's about understanding which sectors gain structural tailwinds, which ones face competition, and which ones need time. Markets reward patience after trade deals, not speed. Trade deals don't lift the markets equally. They reward sectors that are ready to compete.